Hey guys, Sean here. Right now, I think we need to be preparing for a big crash in the near future. For some time now, a lot of us believe that the Fed wasn't really going to hike rates, but this time they might be going all out to battle inflation. Just yesterday, the Fed raised interest rates by 50 basis points to a total of 1% today, but don't let the market recovery deceive you, right? The S&P is up, gold and silver are up, but it's likely just a relief recovery that the Fed didn't go crazy and raise rates by 75 points. The market is still weak and it's looking more like a dead cat bounce than a strong recovery. There is one monster under the sheets many of us are not confronting yet, and that is a massive debt. Now, the United States have over $30 trillion worth of debt, which is a ticking time bomb that's closer to exploding every time rates go higher. And in this video, we need to discuss a doomsday scenario where the Fed really takes us all the way to the promised land of 3.5%, which really isn't enough to fight inflation, but could trigger an epic market crash. So if we take a look at the current Fed funds rate, we can see it's becoming increasingly harder and harder to increase interest rates since 2001. There's a lot of money and debt in the system, and 3.5% just won't cut it. Now, there's a very basic equation that helps us determine how much interest rates will be needed to stop inflation. And many of you might already know it, and it's called the Taylor rule, and I'm going to use the simple modified version. Now, it states that the Fed funds rate has to equal the inflation rate plus half of the inflation gap. So at 8.5% inflation today and a target inflation of 2%, the inflation gap is 6.5%. So to fight inflation, the Fed funds rate needs to be around 8.5% plus half of the inflation gap, and that gives us around 12%, rounding things up. Do you really think we can reach 12% to break the back of inflation without something breaking in the system? Now, there's a good chance that this will trigger and accelerate the greatest crash ever, and that's the reason why it might be the big one. So just take a look at the S&P after 2020. Its move just went parabolic, and that shows how much money is in the system. Where's the next resistance level? Is it at 3,500 or 2,500? No one knows because we have never ever seen the true bottom of the market since the dot-com crash in 2001. Ever since the housing crisis in 2008 and the great money printing in 2020, every crash was halted by helicopter money bailouts and a temporary disaster was averted. We may have never seen the true bottom of the market just yet. Now, Powell and his merry men in the Fed could be engineering one of the biggest crashes or U-turns in monetary history, and I think it's partially out of their control now. And the big issue is that the US economy is based on consumption and borrowing, and I don't even need to pull up a fancy chart for this. Just take a look around you. Half of the people are eyeballs in debt trying to look rich, while the other half are borrowing money just to survive. Now just imagine this on a scale of the entire country, and it isn't just confined to New York or Beverly Hills. At $30 trillion, the Fed cannot afford to jack rates up to even 10%, and it's really simple, right? A monkey can do the math and realize that at 10%, the interest payments alone will be $3 trillion, and that is 13% of the entire US GDP. But the real big issue is how the world will see the United States as a debtor nation, and just raises the question if they can pay back the interest payments alone. And if trust is lost, the market could abandon treasuries and just not lend the US government any more money. This in turn creates a deadly spiral where now bond yields have to rise to entice investors back in, but in doing so, it makes the debt even harder to pay back. And the implications of a rising interest rate for the stock market isn't good. Now, a lot of us are invested in the stock market, myself included, and a rising interest rate sets up a very big dilemma or trap, if you will, for investors. Firstly, when interest rates rise too high, the borrowing costs for companies will exponentially rise. A lot of interest rates are pegged to the Fed funds rate, so if that moves up, the rest will also increase in tandem. So just imagine, if a company takes out a $1 billion loan at 1%, their interest payments a year is around $10 million, which sounds rather reasonable. But just imagine if rates are 3%, now they have to pay triple the interest payments, and if rates hit 10%, their borrowing costs are now 10 times more. That is why we are seeing many companies, especially the ones that are over leveraged or have poor earnings, just crash down to earth, right? There's a big factor why all these growth or tech companies like Netflix and Amazon are down 20, 30, 40 or even 50% within a couple of months. There are a lot of stock bears in the market calling for over 50% drop, in the stock market? Normally, I would say that's unlikely, but the way things are going, it's not impossible. For most of us, inflation is the biggest issue, and that's why the Fed is going all out to fight it. But to fully combat it, raising rates has costs and repercussions. To me, the biggest hazard is the incentives it gives investors, right? And I don't care whether it's a hedge fund manager or mom and pop investor socking money away in the S&P. If interest rates go high enough, people will exit the markets and start piling into bonds. The average investor will be thinking, why should I risk being in a market where companies can't grow and my stocks will likely lose value? I'd rather go to bonds and earn 2 or 3 or 4% interest and just take the hit from inflation, right? At least my capital, at least in nominal terms, won't decrease. Plus, if you're a dividend investor, the stock market paying just 1 to 2% dividends doesn't make sense anymore. So this might trigger exodus out of stocks into safe haven assets, and the knee-jerk reaction will be to treasuries or bonds. Remember that the last time Paul Volcker raised rates to almost 20% in the early 1980s, the market crashed by around 30%. Sure, that is horrible, but just take a look at where we are now. Interest rates are barely at 1%, and the market is down on the whole by 10%. This is very alarming, and this means that things are still quite over leveraged and the downside could be enormous. So the $1 trillion question is if there will be a U-turn soon. Will the Fed act up again and decide to lower rates and pump more money back into the system? We really won't know for sure. It could be if the stock market falls below a certain level and the plunge protection team comes to the rescue, or it could be they manage to really wrestle inflation down to 2% and there's utter chaos and devastation in the markets as a result, blood and fire on the streets. But what we can do is to look back into the past and see what will happen when interest rates are lowered again and money printing comes back into style. Remember that the Fed has a bipolar mandate to not just keep inflation in check, but unemployment down as well. So if people start losing their jobs in masses like back in 2020, we know what will happen, right? The government will start throwing stimulus checks to everyone and increase the money supply that way again. More money will be given to companies to spur growth, and the entire cycle repeats itself all over again. It will be another period of inflationary expansion, and this is where we can prepare, because if the mother of all crashes happens, it could trigger the mother of all reinflation. So how do we position ourselves in the middle of this storm? If we don't invest, our money will be eaten away by inflation, and the Fed could U-turn at any moment. We won't know and we can't look into the future, but if the Fed decides to become the most responsible adult in the room, it'll be at the cost of the economy, and we can see virtually every asset coming down in price. Stocks, housing, precious metals, NFTs, it doesn't matter. Now, I think the number one guaranteed return you can get is to pay down any floating interest rate you have, pay off your credit card bills, and most importantly, stop borrowing money and spending it on crap. Money is going to be more valuable, and it is likely in the short to medium term, we can buy more stuff with it down the road. Inflation will likely still rage on from the supply chain issues as a result of the conflict in Europe. So people who don't waste money will come out ahead 100%. But if the Fed is going to U-turn, right? What if they U-turn? We can see from history that the biggest winners will be the stock market and gold. Equities because of the knee-jerk reaction, and it's the easiest place where money will flow into. Companies can now leverage and grow, and this will just push prices up. Gold because it has been the classical inflation hedge for thousands of years and have outlasted every civilization and stock market known to man. I would be planning to own both if prices dip low enough. The key here is to stay afloat and be prudent. I think we need to focus on survival first, then trying to get rich at this point. Things are so uncertain, and the only winning move, I believe, is to watch your spending and maybe stockpile things that will likely continue to rise in price. As funny as it sounds, maybe toilet paper and toothpaste will give you the best return on investment. Maybe it's time to beef up your bathroom supplies. The war in Ukraine is still going on, and other countries like China and Russia are drawing up plans to ditch the dollar. All these could affect interest rates, so do take the age-old traditional advice your mother would give: spend less and save more, because sometimes the best things in life don't cost money. So let me know what you think. Are we sitting on the edge of a huge market crash, Or is the Fed just posturing and they're gonna U-turn soon? Let me know in the comments below. Be sure to smash the like button and subscribe for more gold, silver, and finance videos. Thank you all for watching, and I'll see you soon.